Good morning, everybody. I know I can feel there's excitement in the air. I'm here at our global headquarters in Scottsdale, Arizona. Welcome everybody around the world to a really exciting and interesting conversation that we're going to have today with Scott Nelson, CEO, founder of Sweetbridge. You're going to know more about a blockchain than you ever imagined after today's conversation, and certainly more about Scott and more about Sweetbridge. Thank you, everybody who are in this location. Normally, when Global Chamber does multi-metro events, we do multi-metros at once. And in this case, a little bit unusual, we're doing one location where the speaker is, and then we've got people calling in from all around the world. So thank you, those of you, and we'll also record this. So if you have any really great questions, it'll be recorded for posterity, and of course the reverse of that is true as well. So I'd like to introduce Scott Nelson. Scott is an interesting fellow because this is actually the first day I've really met him, the first day. He and I have been talking on the phone for, I think, almost 10 years, where I was very excited by his previous company, Trax Technologies, and we'd have these conversations, and they'd literally be something like, Scott, wow, you're amazing. I can't believe what you're doing. You got to speak. You got to be a speaker. And he'd say, oh, I'd really love to, but I can't guarantee I'll be here. So in his previous role, he was traveling all around the world and doing work for Apple company. I think you'll probably mention even some of that. We could never guarantee he'd be there, somewhere. The good news is now with Global Chamber, we do these kinds of events so you can be pretty much anywhere. So, but those days we didn't have this technology. So now with Sweetbridge, when I talked to him a month or two ago, he started telling me what he's doing. And it's like, wow, this is amazing. Do you travel a lot? And the good news was, he's here and he's launching. And yes, he travels a lot, but he's got some better control of his schedule. So the good news is we've got him. We've got him for an hour and a half. He's going to enlighten us. I'd like to introduce Scott Nelson.
Thank you.
Thank you.
Appreciate it. Thank you for letting me do this. This is going to be fun. How many of you, just to kind of set the understanding of kind of where we are, how many of you know something about the blockchain? Anyone know anything about the blockchain? Okay, we got a couple people. Anybody own any cryptocurrencies? Oh, actually a lot more than I thought would actually own them. That's great to know. I can't really see you online, but I'd love to know where people are at. But let me start by taking us back in time. And I want to take us back to 1880. And in 1880, a unremarkable firm, long forgotten, did a radical thing. And the radical thing they did was one of the things that became the pillars of the industrial era. And it was unremarkable at the time because nobody actually recognized what was going to happen and what was going to change. And that unremarkable firm did something which laid the foundation for Google, that laid the foundation for Facebook, that laid the foundation for Madison Avenue and for advertising and for Salesforce.com to serve. What that radical firm did is they created the world's first sales organization. You see, in an industrial era, you needed to have somebody in your organization that went out and talked to people about what you made. You didn't need this in an artisan or agrarian society because you made it in the town. And so this was a new thing. Today, I want to introduce you to something which I think is equally as profound and likely equally as misunderstood, which we will see hopefully through today is something which may indeed be one of the most significant changes that's going to occur in our lifetime. So if we go to the next slide, I first want to kind of set the stage for what's going on in the world. So the pace and scope of change is accelerating. And not only is it accelerating, but the number of choices that we have as a result is also accelerating. This is happening at a compound rate that is now so great that every 2 years, the knowledge created exceeds the knowledge created in the entire history of mankind. And that pace is continuing to accelerate. And this means that companies and businesses are going to become even more and more and more stressed. And so we take a look at this next slide. I want to kind of walk through some recent context of what's been going on. So in the 1990s, we had the introduction of the internet age. And in the 2000s, we had the introduction of the social age. This is where we started to integrate people together as a result of the internet. Now we're in an age that's known as the collaborative sharing economy. What's starting to happen is we're starting to break down the walls and the structures that we needed in the industrial era, companies and other things, in order to get people to work together. We now have places like Uber, and we have things like Airbnb, where people utilize assets or talent that is not part of an organization, but is part of an ecosystem or community. And on the side of all this, there's this new entrance. There's this thing called the blockchain. And what's happening right now is the blockchain, which started as an isolated island, is starting to merge with IoT, which is the Internet of Things, AIs, artificial intelligence, and the collaborative sharing economy to form something new. And that something new is distributed, decentralized, autonomous organizations and economic structures. If we go to the next slide, we ought to ask ourselves a question first: what is the blockchain? So the blockchain is this thing that's terribly understood, highly overhyped, and undervalued. So how can you have overhype and undervalue? How does that actually work? Well, let's take a look. First, let me define what the blockchain is. And I'll use 3 common definitions that are out there, and then I want to move into a different way of looking at it. The first is, one of the most common ways you'll hear the blockchain described is a distributed ledger. So it's like an accounting system that is distributed all over the world, and where multiple people can see what's going on in the accounting system at any time from any place, and can actually trust that the entries in it are actually valid and haven't been monkeyed with by anybody. Well, this is significant. But another way people talk about it is that it's a method of value exchange that doesn't require an intermediary. So you can actually exchange value between 2 parties without a bank, without an escrow company, without any kind of intermediary whatsoever. And this is also a very valid way of looking at it. Another, which you hear a lot less frequently, what I actually think is even more valid than the prior 2, is that it is a shared database that you can't change. Because it's not just a ledger that can keep accounting information, it can store any information. It can store information about you. It can store information about the title to your house. It can store information about anything. So it's a shared database that you can't change, and where the entries in it can be trusted by anyone who has access to it. So there's a whole nother set of people that look at it as a different way, completely different, which is this is the way we basically create a new financial instrument. A financial instrument that doesn't require an exit event in order to create liquidity. This is what cryptocurrencies and tokens are doing. A financial instrument that provides VC and private equity type returns, but to anybody, literally anywhere in the world, not to somebody who is necessarily a sophisticated investor. And something which has a track record to date that is better than most investments in the world. But I want to postulate to you that this is actually not a very good way of looking at it. Because what is happening isn't really that we've created a new financial instrument that allows us to get around the current laws related to securities. What's really happening is something new. And if we don't understand this, we can't separate the hype, which is bad, the bad actors, which are many, the scams, which are also many, from the things that are really going on that are significant. So something brand new is happening. And this brand new thing is probably more significant than the internet. The internet allowed us to basically get information to people in frictionless ways. So you used to go to a library to find something. Now we do it on our smartphone with Google. What's happening in the blockchain is you're talking about value being able to be distributed in ways that have two key attributes. One, it is frictionless. You don't need an intermediary. You don't need a bank. You don't need even a governmental protection agency. You don't need an audit from a CPA firm. You can actually trust the result. That's pretty profound. But more importantly, you're talking about something I call smart money. This is not understood, but terribly profound. You can now actually program money that has a different value in a different context. For example, I could create money that is worth more if I spend it at a female-owned business than if I spend it at a non-female-owned business. I can create money that actually enforces trade compliance in trade. In the exchange, the money itself enforces compliance. I can create money that is worth more if I go to a Fox restaurant and buy a dinner than it is if I go to some other restaurant and buy a dinner. The implications of these things are not well understood, so I want to explore some. But first, let me give you some statistics that are in the press that are kind of important to look at. One is there have been 100 plus TGEs or ICOs, that's an initial coin offering or a token generation event. It's a place where somebody creates a currency and sells it in a crowd sale. In the last 12 months that have actually been listed on public exchanges. These are not regulated exchanges. These are exchanges that exchange cryptocurrencies. There's been a total of $1.3 billion raised between January and the end of last month. Now the number is even larger. And this has happened with those firms having a market capitalization of $1.9 billion, a little greater than that. And most of these firms have no customers, have no revenue. Many of them never will have revenue. Nearly 90% of those 100 plus ICOs that have been listed have a value now after the listing trading on a public exchange that's greater than the value they had when they went public. The average internal rate of return is almost 1,000%. And the average fundraising event took less than 30 minutes. So these are the kinds of things that you hear about. But this is not the important thing to focus on. As in crazy as this is, more money was raised through these events in the first 6 months of this year than was raised in all venture capital investing worldwide. But that's not the story. So if we look into what has caused this, these are the different projects on the here from Tezos at the top to Blockchain Capital at the bottom that are raising money and how much was raised. And if we compare what the projects went for in 2014 when this all started, and there were 26 ICOs, to 2017 today, where year to date there have been 1,266 ICOs as of the end of July. Of those, only 100 were successful. So don't think that this is like some new magic formula, right? That means 1 in 10 really succeeded. Those are the 100 plus that showed up on the prior slide. The rest, though they may have raised some money, they didn't get a whole lot. If you look at what the money is going to, though, remember those tan lines, because we're going to come back to those. This is core technology and cryptocurrency. This is one of the ways that you can look at the problem or look at what's happening in the market. Those are the places where most of the money has gone. But those are commodities. And remember that, because I'm going to come back to that in a minute. So we go to the next slide. here. This wave has caused Forbes magazine in their title cover here from last month to say the craziest bubble ever. And there is truth in this and there is error in this. What's true is that there's an awful lot that's going on which isn't real and which is hype and is going to basically crash. Just like what happened in the early years of the internet. But what isn't true is that we are yet at a bubble in the sense that the internet crash of 1999-2000 was. At that point, we had trillions of dollars of market capital that was invested into the internet businesses. Today, blockchain businesses only have about 150 billion based on today's currently trading numbers. I looked at first thing this morning because the number changes every day. In market capital. We are a long way away from kind of the major bubble event that would happen in the internet when things just got overhyped. Next slide. What is really going on? This is the meat, okay? This is where the steak is here. What's really happening is we are seeing the introduction of a new business model. And if you look over the last 70 years, we've seen the way businesses get evaluated move from manufacturing businesses that were valued at by taking profit times some discount for risk times 5 years. Back in the 1950s, that's how you would value a manufacturing business. To today, SaaS businesses, which are reoccurring revenue times growth rate times some multiple, which is usually something between 3 and 5. Over that period of time, we've seen business valuations for the same levels of revenue and profit skyrocket. Today, we are looking at something new. And these are network-based business models. And if you don't understand this, you miss everything about what's going on economically in this whole area of blockchain. Because it is not that somebody has an ICO and they make a bunch of money. It's not that you own Bitcoin and it goes up in value. It isn't a pyramid scheme. It isn't any of these things that you hear out there. That's not what's really happening. What's really happening is a new way to look at the valuation of a business. And it's the same way you value an economy. It's the same way we value the US economy. And that is significant. You're now talking about businesses that are able to be valued based on the amount of economic activity divided by the number of turns in the currency. So if you apply this model to Bitcoin, by the way, and you ask, why is Bitcoin worth over $4,000? And you say, what is its economic activity and utility? And you actually divide it by the number of times it sells based on how many times it's traded. What you'll find is that its value tracks almost exactly to that formula. If you take the mean value of it on a average basis of 90 days for any period of time you look at it in the last 4 years, which means it's not really overvalued. It's actually valued at about where you would expect it to be. So to understand the space and what's going on, you have to understand that not all of these cryptocurrencies or tokens that are being created are the same. One is a commodity token. Those ones that were the most valued, the ones that were the tan lines, the ones that represented the bulk of what's been raised, those were all examples of commodity tokens. Commodity token is a token which allows you to exchange value. The ones that I think are the dumbest, the ones that I think are hype, the ones I think that will, in the end, be squashed on and killed both by governments and also because people in the marketplace will realize it's not really the same thing, are tokens which really are just a way of getting around the how we act and are really securities. The reason is a security has no network effect. A commodity, an exchange of value, has network effect, as we'll see in a minute. There are two other kinds that are worth mentioning these are on the rise, and in the end will become the more common ones. They'll be most frequent, but not necessarily most valuable. Most valuable will be commodity tokens, but there's worker tokens and app tokens as well. And a worker token is a way of paying for work, like storing files on a computer system, or paying a graphics artist for the creation of a design. An app token works more like a software license. Like if you own it, I can use the system, but if I don't own it, I can't use the system. So you've got to kind of put a coin in every time you use the machine. Next. This is what this is all about. So a network business is valuable because the more people that join the network, the greater the value of the network to each member. You know, when you were the first person to sign up for Facebook, it wasn't terribly interesting. But now that over half the world uses Facebook, it's very interesting. When you have one telephone, it's not very interesting. When everybody has a telephone, it's exceedingly interesting. And so in network-based business models, the value to each member increases as each member is added. This has been known for some time. But the problem is creating a network business model is really hard. It's very difficult. And the reason is because early on, there's very little value. So why join it? What tokens allow you to do, and what is happening in the cryptocurrency spaces, is it allows you to provide an economic incentive for people to join early. And the reason it does this is that you limit the supply of tokens. You say there will never be more than this many Bitcoins. This is it. This is the maximum number. And you release those into circulation a lot early, and then gradually you release less and less and less. What this means is it's very cheap to join the network early. You could have bought a Bitcoin early on for a few pennies. I actually had a son-in-law who tried to talk to my daughter and tried to convince her to buy $100 worth of Bitcoin when it was trading at 7 cents. If she had allowed him to do that, which she thought this was the stupidest, craziest, most insane idea, that would be worth over $100 million today. True story. So what makes it valuable to join early is the price is low. And then as the network's use goes up, you end up owning a part of the value appreciation from the network. So imagine Uber, which is a network business. Imagine if as a rider for Uber or as a driver for Uber, you originally had gotten tokens that represented a share of Uber. Well, initially those would have been very inexpensive. And if you look at the Uber model and you apply a token economics to it, the first 1,000 drivers would all be multi-millionaires. The first 100 riders would all be multi-millionaires. That is what's happening. Next slide. So token models are different because they're typically nonprofit organizations. Crazy. Money is made not from profit and not from stock, but from the valuation increase on a limited asset, which is a token, which has a limited supply. So when there's a small number of people on the network, there's not a lot of competition for the token. But when there's a lot of people on the network, there's a lot of competition for the token, and so the token goes up in value. Money that is raised is usually paying to develop the network. So it's money being raised to develop the network and to provide ongoing support. Many will never generate $1 revenue. Their entire business model is based on an ever-expanding network size where the value of the token becomes greater and greater and greater. Miners make money by running some of the world's most powerful computer systems, burning more energy than is burned by the country of Uruguay to mine transactions to ensure that the Bitcoin network is secure. There's more computing power in the Bitcoin network executed every day than there is in 1,000 supercomputers. That coin that's created is the incentive for people to basically incur that cost. Buy the hardware, pay the electricity, pay the cooling bill, have people there to repair the equipment when it fails. But there is no revenue. Tokens are used to incentivize this adoption in the chicken and egg model, and many of these projects are open source, so they don't even try to protect their IP. And the reason is that you're locking up so much value, you actually want people to basically have access to your source code so they can see that you haven't done any shenanigans. Otherwise, they wouldn't trust you. And that's why it's open source. Some other differences that aren't true of stock. First is tokens tend to be tradable if they get listed on an exchange 24/7. There's no time at which it stops. They're tradable all day long by anyone from their cell phone. They're listed typically within days or hours of an initial coin offering. And holders have a very limited role in governance. It's not like owning shares of stock where you can vote for a board of directors and manage the business. Usually there's no kind of governance role like that. Token sales are public events and people all over the world participate, not just people within a certain country or geography. And tens of millions of dollars are raised in seconds. Now, if we take a look at market capitalization, this is over the last year up to the end of it. What's the date? June 10th. So June 10th to June 10th, 2016 to 2017. What it looks like is that things are just starting to take off in the first part of this year. Second quarter time frame, things are really starting to take off. But that's not really what's happening. If you look at the graph at the top, and I realize it's kind of obfuscated a little bit by the my image up there, what it shows is that the actual rate of increase on an exponential basis, which means if you took a look at how fast it's growing and you applied the rate of growth, not the amount of growth, the rate of growth for the last 4 years has been basically flat. That means that this is not an anomaly. That's what happens in babies when cells divide and grow. That's what happens in organic systems when they grow. This is a phenomena of all network-based businesses. This tells you basically if that line was sharper than what had been going on, that would be a bubble. That's not what's happening. Okay. Next slide. Initial coin offerings happen, according to the press, really quick. There's like 60 days from white paper to ICO. I can tell you that a successful ICO is as hard or as difficult as doing a successful public offering. The idea that it happens instantly is nuts. Another thing you hear is you raise lots of money and people are just getting insane sums of money. Responsible projects that are doing ICOs put a cap on what they're doing. What is true is that it happens fast. Oregon, for example, raised their $25 million in 35 minutes. Brave raised their $35 million in 35 seconds. Almost all of their stuff was in one block on the internet. In fact, it was all one block. This is a completely different animal than what we're used to dealing with. Next slide. So all the facts and figures are interesting, but it's really helpful if we can see this. Okay, this is a bunch of information. I'm not sure how this relates to my business. I'm not sure how this actually connects to the world. This all sounds very interesting, but so what? So I want to take and walk you through an example using the project I'm involved with and the founder of Sweetbridge and show you what it means to apply what we just looked at in a real world case to something that I think will probably challenge your beliefs about a lot of things. So let me give you some background on what Sweetbridge is first. So we are a blockchain alliance, meaning we are not just one project, we're actually multiple projects working together to create a liquid supply chain. Now, I'll explain what liquid means, but first let's explain what supply chain means. So most people think of a picture like this when they think of supply chain, if they even know what the word means. They think of it as a containers coming in from the Far East on a vessel. Well, the better way to think of it is it's either Mother Nature or the supply chain. So everything you eat, everything you own, everything you wear, everything you live in or work in, drive in, all of those came to you through a supply chain unless they grew where they were or were created where they were. So what is that? Well, that's $74 trillion of global trade. It is global commerce. I'm sorry, 54 trillion. Global GDP is about 75 trillion. So this is 2/3 of global GDP is managed by the supply chain. It is all of commerce in the world. So it's all the goods, materials, things. It's everything other than things like financial services and governmental projects and some aspects of healthcare. Now, how can a supply chain be liquid? Well, today there are tens of trillions of dollars tied up in these supply chains in working capital. This would be the money that is tied up from the time somebody orders something from somebody until they get paid for fulfilling that order. But all of the assets, the factories, the boats, the airplanes, the trains, the inventory, all of the assets are also locked up. I can't convert those into something liquid that I can trade. I can't trade a factory or part of a factory. I can't easily trade the money is locked up inside of a container ship. I can't easily trade money in inventory. I have to sell it to somebody. So money that I put into those assets is locked up. And at any given time in the supply chains of the world, there's something in the neighborhood of $120 trillion locked up in the assets of the world. So we are trying to turn that all into something liquid, which we can now do using this thing called the blockchain. Now, first, it's not just a small group of people that are doing this. We are probably a large project with a lot of people from a lot of different backgrounds and experiences. We've got about 22 people that are full-time and about 40 some people that are involved in total. And these include people who are Federal Reserve, ex-Federal Reserve economists to people that are, mathematician quants to people that are trading experts off of Wall Street to technologists and people from governmental or legal backgrounds. We have an alliance, as I said before, made up of multiple organizations, including ASU here. And we are creating ecosystems for different aspects of the supply chain and global commerce. The first two that we've focused on is supply chain and law, but we have a variety of others that are currently under development. Next. But I want to kind of take this into what you can do. And I wanted to go through all that first just to give a little bit of credibility. So as we already said, there's trillions of dollars tied up in this picture. Okay, trillions of dollars. Everything from the orders to the actual inventory to the assets in the buildings. In fact, there are about $700 trillion worth of valued assets in the world. And there is only about 60 to 70 trillion in currency, which means there isn't enough currency to create liquidity for all the assets. This occurs, according to economists, because we have one currency in each country. So economists for over 100 years have been suggesting that it would be better to have two currencies. And in fact, historically, there always was. It was about 1850 or so that started to go away. Little known fact, in the 1850s in the United States, there were thousands of currencies in use and circulation. They were called banknotes. You ever heard that term? That's what they were. You would take your farm, a title to your farm, or you would pledge your crops for the next year to the local bank, and they would give you banknotes. And you would take those banknotes and go to the merchant or the general store, and you would buy stuff and that you needed. And you could go get your title back or redeem your debt once the crop came in, or you basically just paid back the banknotes. And this is how banking was done all over the world for 4,500 years, starting with the Egyptians, who created the first tokens in the world. This idea of tokens, by the way, isn't new. They were clay tablets on which they wrote inventory amounts in cuneiform writing, and they had the pharaoh's seal that they put on the clay tablet. And then people would exchange that clay tablet, because even back then it was impractical to take camels and stuff around everywhere. You couldn't just take a bunch of camels to market with a bunch of grain to buy some wine for the wedding that you were having for your daughter. That just didn't work, right? So this is what happened. Gold and precious metals were what were used to trade between economic systems or between markets or between banks. And that was called specie. So historically, we had two currencies, one which was for liquidity and one which was for settlement between parties that provided liquidity. So I want to take you on a journey, we go to the next slide here, of how we can change this process. First, I need to introduce two concepts. Two tokens, which Sweetbridge is creating. One is a token for liquidity. It's called Bridge Coin. It's pegged to fiat currencies. It's either the most exciting or least exciting cryptocurrency you ever heard about. If you're into crypto speculation and hype and whatnot, it's terribly uninteresting because it's pegged to fiat currencies. So it basically is paid to dollars or euros or whatever, and its value is related to that currency. So it stays relatively close to that currency's value. The other is Sweetcoin. Sweetcoin is a mechanism that is similar to FDIC insurance, except instead of the government owning it, the network owns it. And it allows, if you have it, it allows you to borrow money for free, interest rate free, to get settlement activities between parties free, no network charges, and to move in currency from fiat world into crypto world back to fiat world also for free. Now what this means you can do is that you can lend yourself money from assets you already own on your phone without another party, without a bank. Those assets can be a cryptocurrency. Those assets can be a house. Those assets can be inventory. Those assets could be Royal Mint Gold. It could be stock ownership in a company. This is the implication of all those facts I gave you about the blockchain earlier. And all of this can be done. This is you borrowing from you to get something liquid out of something which is not liquid that you have to pay back. Then the blockchain will force you to pay it back for something called smart contracts. And if you don't pay it back, it'll sell your asset. Just like the bank. If you don't pay back your mortgage, they'll sell your asset. So this is all possible because of the blockchain. And it is things like this that are going to rewrite everything we think about how things really work. So the implications here are profound. Interest-free mortgages. How would you like one of those? I have a feeling that might be quite popular. You can combine all of your assets together into a portfolio. Your house, your cars, your income is an asset. Your income is an asset. It's a reoccurring revenue stream. Intellectual property that you have, skills, all of those things will be able to be combined into a single portfolio off of which you can borrow whenever you want. So business can take their receivables, the equipment they own, the desks, the computers. They can take the inventory they have, the buildings that they own, and they can basically have a line of credit on which they can borrow as needed as long as they pay it back. That's all that's needed. Now, why can this happen interest-free? Well, because interest is paid for two reasons. The first is to rent the money from somebody who has it. So the reason you have to pay interest is because you have to get money from somebody who has money. Remember, it's only 60 or 70 trillion in currencies in the world. So if someone's going to lend you if they own those currencies, they're going to lend them to you, they could do something else with them. They could invest in a business. They could go out to eat. They could take a vacation. They could buy a new jet, whatever it is that they might want to do. And you have to convince them that it's better to let you have the money than for them to keep the money and do whatever they want with it. So you pay them interest. Well, the reason you don't need to pay interest in the blockchain is because in the blockchain you can create currency from nothing at no cost, a couple watts. When you say, well, how can you create currency from nothing? Well, our government does that every day. So does every major government in the world. And what backs the currency is the economy and the rules that govern the bank. So we all believe that the banks have all the money that they need in them to basically, cash our check or whatever when we want to go in or withdraw some money. Go to an ATM, we'll always get our cash, so we're comfortable with that. We all believe in that. We believe in that because the government has put in place systems and processes, rules and regulations that are enforced by the banking regulators and governmental officials that make sure that that's happening. In the blockchain, you get to enforce these things through smart contracts. Contracts which act like laws that you can't change, they're impossible to override, and which are enforced to occur. So you can take the same rules, same laws, same principles that are needed in banking, and you can basically encode them on the blockchain, and the blockchain will enforce it. But without buildings on every corner, without those towers that cost lots of money that have labels on them, without the thousands and thousands of employees on their staffs, which cost lots of money to pay for, that need a lot of money and profit to be generated from renting out money in order to pay for it. So I wanted to just kind of give you an overview of what's going on in blockchain, talk about the economic change that's occurring. Because what we're talking about now, this is the bottom line. The blockchain allows you to create new economies. It allows companies to band together and to cooperate together to create entirely new economies that do not use fiat currencies, that sit on top of national economies, don't replace them, they won't make them go away, but don't require governmental officials, intermediaries of any kind, and institutions to enforce the rules, where the rules are enforced by immutable laws that cannot be changed on the blockchain without the agreement of all of the parties, at least 51% of the parties who control the blockchain. This means we can create network businesses where you own a part of the economy. You own a part of an economy. That makes you an owner of, in essence, a governmental system, a trading environment that as it grows and gets expanded and gets larger, you get to participate in the value increase of that economy. I believe that to be the most profound thing that's going on with the blockchain. I believe everything else is noise, and I believe that is going to enter us into an entirely new era of business, an era that is different than the industrial era, the distributed, decentralized, autonomous era, where everything is connected to everything, and every transaction is governed by a protocol which rewards positive behaviors and disincentivizes negative behaviors. And that is happening under our feet without us knowing it, and we'll wake up one day and realize it occurred. So with that, I'd love to take questions.
And all the bankers in the room are circulating their resumes.
Well, don't do that, because banking is not going to go away, okay? It's not going to go away. Banks do good things besides just charge people interest.
Financial services. So it's going to take a little time.
So let me tell you something. I used to believe that. I used to believe it was going to take 20, 30 years for a lot of these things to happen. I now think it's happening at rates. It's happening so fast that it's hard, it's breathtaking. To be involved in the industry, it's just crazy. I've never seen anything like it. I cannot believe the pace. It's far greater than the pace of the change of the internet. I was involved with that in the early years. So I don't think it's going to take as long as you might think. It's still going to take some time, but it's going to be fast.
Okay, how much time? What kind of happens if you look out into the future?
So if you follow the adoption curve of, say, cryptocurrencies, which is really interesting, they were growing at a rate of about 7 times. So the number of people using cryptocurrencies in the world were expanding at the rate of 7 times a year, up from 2010 up until the beginning of this year. This year, it has been doubling every single month. So you're seeing we're hitting an asymptotic curve right now. If that trend continued in 3 or 4 years, pretty much everybody will be using some form of cryptocurrency.
Gotcha. I think there's a question all the way in the back with Mike Patterson, securities attorney.
Yeah.
Your job is not going to go away either.
Lawyers are nervous too because, smart contractors can replace us.
So they won't. No, let me tell you something.
I know that we're doing it. We have a fintech. Sorry.
Yeah, come
on. Could you come up so that you could
So
speak into the microphone?
we want to get the mic here, because this is a great question. This is going to be a boom for law firms, by the way, because they're going to be able to turn their businesses into recurring revenue businesses. Go ahead.
So this is Mike Patterson.
Mike Patterson, lawyer.
Right, and thank you. And by the way, I'm thrilled that you and your firm are at such a sophisticated level going to help people. And just as a joke, I remember sitting in a law firm partner meeting years ago in a smaller firm and hearing the question asked, so why do we need a website for our law firm? This was not that long ago, right? And some of you have probably sat in the room and heard that question too. Why do we need that? And things that get adopted and we all need it and all use it. And one of the things that we have a fintech practice, and the head of our fintech practice, who's a blockchain expert as well, thinks that it may become the biggest practice in our nationwide firm of 850 lawyers.
What firm are you with?
Pulcinelli.
Okay.
And Rick Levine. And
we'd love to get you involved in our alliance because we have a legal ecosystem.
Excellent. And one of the reasons he joined our firm is it's not my practice, but we're the largest healthcare law firm in the nation. And he really believes that blockchain, the technology, will be used. All of our healthcare records will be stored in blockchain within 5 to 10 years.
Yep.
One of the things that I see about it that's so fascinating is examples given in like international transactions. Everybody in this room very interested in international. When a ship is leaving, Beijing and stops in Argentina and ends up in Long Beach, after going through the canal, et cetera. All the transactions all along the way the insurance companies who are insuring that, all those containers on that ship, et cetera, all of those transactions involved in that, and if there is a loss and it gets detained, and the payout of the insurance and the payout of once it hits the port and this document is transmitted to that document and payment takes place, et cetera, all those things that involve thousands and thousands of people for one ship and all the containers on it to touch it and be involved in that can be handled and securely and without fraud.
Yeah.
All the participants in the network of a system of blockchain would have to agree before this document right here is altered in any way, and that currently is not the system in a people-based system, where everybody's touching it. And so I'm excited about the future.
How can we live without fraud?
Yeah.
So it won't eliminate fraud, it just will eliminate frauds in certain areas.
Right.
A big thing that blockchain will allow is to enforce trade compliance, for example, in supply chains, and that will be something that can just be enforced automatically when you actually sell the goods. When the goods are transferring, they won't actually transfer title unless it's a compliant trade. And they won't even, and the taxes, duties, and whatnot will be calculated and automatically paid at the same time. There are projects in our alliance that are working on that technology right now. So,
Thrill, I'm sorry.
Yeah.
Oh, did you have a question?
No, just
he's just excited about the topic.
I'm excited about the platform, but would you agree that currencies were the initiative of this and how it began, and the supercomputers and the rooms, et cetera, but really the impact on our lives is really beyond the digital. If people just equate blockchain with digital currency, that's one piece, but really this technology that's been created in the system and the network is radically going to change our lives in healthcare and the way we do business. And the great example you gave of how I loan money to myself and products and services that are going to become available that never existed before.
Yeah. Yeah, it will reshift and reshuffle major industries. Insurance is going to be completely redesigned. Banking, as we know it, will be completely redesigned. Supply chains, buying a home. So in the near future, here in Maricopa County, you'll be able to actually use a cell phone to basically buy a house on your cell phone in seconds. No escrow company, no title company, nothing.
William,
Question.
could you come up and ask the question? This is William of Dixon Golf.
Hey,
William, what's your
William
last
Carey.
name? William Carey. Good to see you.
Two questions that just popped in my mind. So if I'm loaning myself money, how does the enforcement go? So I don't pay myself back.
So the
If I
blockchain
don't
monitors
pay
that.
back, they obviously take
Who
my
sells
assets.
William's assets?
Yeah.
The blockchain.
Well, who comes and gets them out
So
of my grubby hands?
yeah, so it's the same people that get them out of your grubby hands in the world today.
His name
So
is William.
So it's the process of that is instantaneous rather than.
So what happens technically is that the smart contract monitors the terms of the loan. If you don't honor the terms of the loan and don't fix any, cure periods or whatever, what happens is that your asset gets sold on an exchange. That exchange allows somebody to buy it who will go through the process within the real world legal environment to basically get, possession of it.
Okay. The second question is
Just what happens today.
So for all of us, he gave the example of the internet. You get a website. What do we do about this change?
So that's a great question. So one of the most important things I think anyone can do is to start to kind of play around with trying to understand the space. And every dinner we go to with people, my wife who's in the back of the room here, but starts the dinner talking to people about what we're doing, and by the end of the dinner she's helping somebody download a digital wallet on their cell phone and buy a modest amount of digital currency. It is a world that works very differently than what your mental models are prepared for, and so the models you come at of passwords and bank apps and other kinds of things, that's not how it works. And it's very important to learn how to actually work in it. It will be very important. The other is just to start reading and educating yourself. There's fabulous resources out there. Anyone who wants to send a link to an email to us, we have a whole list of things we use to kind of educate people that we can put out to kind of educate folks. Yep.
Could you come up, Alicia? So Alicia has a question, and I'd like you to come back to insurance as well. I know there's a couple of insurance folks they've included to understand how that works. Alicia, you want to come over here?
So,
Alicia Engel.
so if we all become part owners of the economy,
Yes.
then what is the role of government when it comes to public services? How do those continue to be funded? Do our taxes, are they impacted?
Yeah. So those are great questions. First, when we talk about an economy laying on top of an existing economy, it doesn't do anything to undermine or change how the existing economy works, and the existing economy still needs to function. There are, for example, in our world, the reason we pegged our liquidity token to fiat currency is that according to the economists on our project, if we didn't do that, it would destabilize the central bank of national economies, and they would lose the ability to basically manage their economics for their, of their nation state. And that would be bad, okay? First, they'd probably find some way to outlaw it, and secondly, it would be bad. So because it would create disruptions that would harm people. That's not good. So you're not really replacing any of those things. What's going to happen instead is quite the opposite. What all this will do is actually lead our dollars to become the currency we use for assets. And that's going to actually cause the value of the dollar to increase. The other thing that's going to happen is that the economy is going to grow. So, for example, according to our economists that we've talked to on our team, if, for example, you freed up the liquidity tied up in just receivables in the supply chain of the world, that'd be about $27 trillion. And in the global economy, there's about 5 turns of money a year. So what that would actually mean is you would actually grow the global economy by $5 trillion. So that'd be meaningful. Okay, that's about a 7% growth in the global economy from doing that. And so what should happen is actually the economies of the world should actually increase and grow as a result of these things happening. And that should actually give governments more money. And then on the tax question, what is currently happening is going to stop happening. So most of the blockchain originally got its fame from drugs and bad things being sold in the dark net and stuff, and people using digital currencies. So the blockchain can actually be used by governments, and you're seeing certain ones adopting this. The government of Dubai, the government of Estonia already have active projects in the space. The blockchain can actually enforce real-time tax compliance, which means literally that you would not need to do a tax return. You wouldn't need to do one for your business. You wouldn't need to do one for yourself. If all the transactions were on the blockchain and operating in a blockchain that was governmentally compliant for tax, it would actually calculate the tax, pay the tax in the middle of your transactions. And you would just never ever see the money that wasn't yours. And governments would actually get the money real time. So the money would actually go right into the treasury as soon as you conducted a trade or as soon as you got paid or whatever. Where today all that has massive time delays, which actually increases the amount of borrowing the government has to do. This would actually decrease the national debt, and it would actually help the economy. Well, I actually kind of like the idea.
I also had questions about
Follow-up question, could you talk about?
Yeah.
Yes. So I had a follow-up question. Yeah,
Sure.
you touched on it. This idea of developing economies. So
Yes.
it sounds like the developing economies do have access to the technology to become involved with these types of projects to actually try
Yes.
to move themselves forward. Can you talk a little more about that?
Sure. So this is a great question about how to get involved with these developing economies. Places like ASU and the Blockchain Lab that's been announced here at ASU is a great place to get plugged in to start learning about stuff, finding out what's going on, participate. There are meetups that are out in the valley on a probably every week there's one somewhere in the valley, and getting involved with those is a great way of kind of staying aware of what's going on and being involved. Most of these are free. In some cases, they even give you free pizza and beer just for showing up. So they're great ways to meet other people and learn more about it. Yep.
Very good. Well, Dave, this is Dave Binsfeld with Southwest Insurance.
Great.
While you basically intimate that countries that have assets are going to be advantaged.
Yes.
So is this really making America great again? Like the real reason?
So that's going to be more a political question. But I think
from the standpoint of favoring countries that have assets today, China, Japan, Germany, UK, US, don't we get advantaged?
So the countries that have assets will have an advantage, but the countries that have limited access to capital, take somebody like Vietnam and rice farmers. I don't know about you, but this idea that if you work hard, you'll get ahead, that I was sold by my dad. Let me tell you, I've actually seen what rice farmers do for a living. They are the hardest working people I have ever met on the planet of Earth, and they don't make anything. But rice farmers lose about 70% of the value of their rice through nothing more than finance charges in the supply chain. And so by reducing those costs, that's actually going to mean that the average rice farmer is going to see more economic value. So what will happen is that the places where assets have lots of value and already exist, like the United States, will get liquidity. The places of the world that don't have access to capital and have large costs for capital will actually have probably a larger percentage of economic growth. So they might see a 20 or 30% growth rate as a result of some of these things in some smaller underdeveloped countries. But it will become much harder for despots and corrupt political leaders to manipulate the economic environment because people have a choice. They can move out of the local economy and into the digital economy, which is policed by a blockchain if they want to. And that will create a tension, I think. So both are going to grow, but they'll grow in different ways. That's the
great news.
Yeah.
Were you worried about the insurance question?
No, that's I'm not about insurance.
Okay.
It's intriguing, but so the question is, say like Bitcoin or those successful currencies, if they're appreciating so quickly, are you seeing that people are no longer spending the money to actual? Yeah,
they're horrible for liquidity. They're horrible. I mean, Bitcoin will never, the idea that we're going to use Bitcoin to buy stuff is nuts. If you have an appreciating asset, you're going to delay selling it, right? So that puts off spending it. And that's why these cryptocurrencies that increase in value, like Bitcoin, Ether, Dash, whatnot, they're not very good for liquidity. So because you don't want to get rid of them, you want to hold them. They're more analogous to gold or precious metal than they are to a fiat currency. That's why we created Bridgecoin, and Bridgecoin is unexciting. So its value will never be significantly more or less than $1 or €1 or whatever, depending on the denomination. And that's what you need for liquidity. You actually want that currency to slightly depreciate in value. Most economic models suggest that the best is about 2%. That's why most of the nations of the world, the industrial nations of the world, print 2% more money into their money supply. Most people don't know this. Every year, just as a matter of practice, irregardless of what they're trying to do to control inflation, just so that the value of the dollar keeps dropping. If it isn't slightly depreciating, you have an incentive to hold on to it, and that's actually bad. What makes economic activity in an economy is when people spend their money, not when they hoard their money. And that's it. And so that was a great question.
Thank you.
Yes.
Looks like William has another question. While he's walking up, one of the questions from around the world is really what is going to happen with insurance? Because you can't insure yourself, can you?
Yes, you can.
Okay. How
Do you want the insurance question first?
Yeah.
Sure. Insurance is probably going to be one of the industries that will go through most change. There's projects out there like Ether Risk that have actually have functioning prototypes that they have done where people can actually buy flight insurance as an example. It's purely just as a prototype. And it's you insuring yourself to have a delay in a travel trip. And you buy insurance. The smart contract monitors the flight. If the flight's late, it basically pays you out the insurance reward. And all this is just you and the blockchain. There's no third party. There's no insurance company. There's no independent party. And therefore, there's no profits held by anybody. There's no staff charging extra interest or anything in that process. That works for things that you can measure. As long as you can measure it in a way that people couldn't manipulate, that works. It won't work for things like medical insurance or other kinds of things, but there are other ways those will happen.
Okay. Gotcha.
Okay.
I'm going to buy flight insurance and then fly United. And just the question I had involves there's so many cryptocurrencies coming online. So are they going to work together, or are a couple going to emerge as the cryptocurrency that we use? Of course, it's going to be Sweetbridge but that's my question. How do you do it?
Sure. So this is a great question. I get this question a lot. There's actually well over 2,000 cryptocurrencies out there. What's going to happen? Are they going to proliferate? Whatnot? The answer to this question is that slide that had the 4 tokens. So commodity tokens will be limited. There'll be a limited number of commodity tokens long run, I think. And they'll be organized to different kinds of commodities. So they'll have different use cases. There already is an oil token. An energy token for electricity. There already is one. One for diamonds already is one. A couple for gold, including Royal Mint Gold. So those will be around different kind of commodities and commodity classifications within certain legal jurisdictions. And there'll be some multiple of the commodity class and the number of legal jurisdictions, because in different parts of the world, there are different laws that govern commodities. But that will be a finite set. Security tokens, I think, are here to stay. I think they're stupid. I wish the SEC would stop them. I think they're a bad idea. I don't think there's some things about them that are good, but they really miss the point. They're getting a lot of press, and it takes up a lot of noise in the room, and they're terribly uninteresting because they don't behave any different than an instrument we already have today, which is a share of stock. And you can do some things that I think are good, like trade them and whatnot earlier, and I think that's good, and hopefully that works out. There'll be as many of those maybe as there are companies, because they're just a replacement for stock if people keep doing them. Worker tokens will be larger in number. These are tokens that have a specific purpose, like there's ones out there for file sharing, where instead of storing your files on AWS or on your own computer, you can back your files up, and you have to buy a cryptocurrency, which you then spend to pay the party who's storing your files. And those files are split up and encrypted and stored all over a distributed network. And that there'll be as many of those as there are use cases, out there for doing that. App tokens will be the most. There'll be more of those than anything else. They're like a software license, and there'll be as many of those as there are kind of apps that want some kind of software license for a token. Until we start talking about them in these ways, I think there's just tons of confusion, and it's kind of unhelpful to talk about cryptocurrency as a whole unless you know, well, am I talking about a commodity, or am I talking about a security, or am I talking about an app token, or am I talking about a worker token? And there may be some additional classes that we haven't seen emerge over time. But those are the 4 primary classes that exist today. In the front.
We have a question.
Another one.
Introduce yourself, please.
Yeah, I'm Topher Speth, part of Global Trans right now.
Oh, yes.
So my question is on the evaluation of assets. You keep on saying that you can basically loan yourself money.
Mhm.
Obviously, those assets have to be evaluated for the blockchain to accept them as collateral for
Yep.
that loan.
Yep.
Is that evaluation taken care of just as part of the smart contract says who's going to do the evaluation, or is there another mechanism?
This is a super important question. So in order for something to be used as collateral in our system or in really anywhere in the blockchain, you have to have a market. And you need to have more than one market way of evaluating something, otherwise the market could be manipulated somehow. And the mechanism that manages this market evaluation is an oracle. It's called an oracle. An oracle is an off-blockchain device that certifies through a financial stake that it has its risk to the blockchain, that information it is publishing on the blockchain is real. And there are multiple ones of these for financial markets already. Major commodity markets, pork bellies, corn, oil, energy, precious metals of different kinds. There's some under development right now for bonds and stocks that are traded. There'll need to be additional ones. In our world, we'll be creating ones for inventory. You can kind of use what Alibaba and Amazon sell something for as a mechanism of the value for many goods, but there are still certain kinds of things that are bought, sold that aren't sold or bought on Amazon or Alibaba. So you can't, there are certain kinds of things you can't do that with. Some things you can value between trading partners. So like the value of an order is the price that's been agreed by both parties. So it's, they've put a value on it. So the valuation mechanisms vary depending upon the nature of the asset.
Okay. And all of those valuation methods are referred to as oracles. That's not, so
No.
anything, okay.
So only external ones that are external to the blockchain.
Okay.
If you had two parties buying and selling something and they agree on a price, that information can be put on the blockchain itself. You don't need an oracle in that case.
So the oracle is just an outside kind of system of value. Like Amazon would be considered an oracle if you were...
No, an oracle would use information on Amazon and
gotcha.
publish it to a blockchain.
It's an
Right.
entity that,
Yeah.
okay.
And then they charge a fee for doing that. And they put up a financial stake that says, if we ever lie or you can ever prove that we did something wrong, here's this smart contract that controls this money that is usually some ratio of the amount of transaction volume they're handling. And if anyone finds that they've done something wrong and demonstrates that to a network of independent parties, then those parties can basically vote to basically take your stake. And
What would be the value of using an oracle versus just identifying a system of record, like saying, for these commodities, we'll value it off of Zillow, or,
you need somebody. So somebody could hack Zillow and then manipulate the price of, say, the largest office tower in downtown, Zillow doesn't do office tower, but, just some multi-$100 million piece of real estate, get it to be priced at 10 cents or something.
So you need someone with skin in the game.
You have to have somebody with skin in the game. And that's a principle in the blockchain in total, is that you ensure people have the right behavior by by having them have more to lose by being a bad actor than to gain by being a bad actor. Yep.
Very good. Well, I think we're going to need to wrap up. So we have someone with skin in the game. Speaking of skin in the game, Scott is doing this startup. How long have you imagined this startup in your head?
Well, we've been working on this for about 1.5 years.
Okay.
But not quite, I guess, a little over a year. But some of the ideas behind this go back to things I've been working on since 2004.
Okay. Fantastic. Well, we appreciate you being an oracle for us today.
Thank you, Doug. Thank you very much.